When markets get shaky, the average investor starts obsessing over the wrong things. Headlines, predictions, even social media rumors. But wealthy investors, they ignore the noise and zero in on what they can control. And one of the things you can control is your asset allocation. Lately, equities have been outshining other asset classes, but that doesn't always last. A well-thought-out portfolio, especially one that requires steady and predictable income, needs an approach across a few different asset classes. Hi, I'm Stefano Francesca, Certified Financial Planner and Senior Wealth Advisor at Next Step Wealth Management with IPC Securities Corporation. For over 30 years, I've helped Canadians take control of their finances, navigate volatile markets, and retire with confidence. Whether you're building wealth, approaching retirement, or just trying to make smarter financial decisions, this channel is for you. And if you find value in this type of content, make sure to like this video, subscribe, and hit the bell so you don't miss future uploads. Today, I'm excited to sit down with Faisal Ahamed, who manages the VPI Corporate Bond Pool. If you've ever wondered what goes on behind the scenes in fixed income investing, you're in the right place. Faisal and the rest of the team at Cancel Investment Council live and breathe bonds every day. Faisal, it's great to have you here. I know your team has been busy navigating some pretty interesting market conditions lately, and I'm looking forward to digging into what's happening out there. So let's jump in and see how you're helping clients stay ahead. To kick things off, can you share your perspective on what's happening in fixed income markets?
Absolutely. Thanks for having me today. Really, let's back it up here. Today, there's still a lot of policy uncertainty. Recently, we had a couple of rate cuts, both Bank of Canada as well as Fed, but we're still seeing a lot of uncertainty. And where we're seeing that is the costs associated with tariffs, and there's a lot of unknowns here. The markets are ignoring a lot of the inherent risk. Where we focus on at Canso is credit risk and credit premiums. With base rates going up, so Government of Canada rates and US Treasury rates elevated, and yields staying similar to where they were, that's compressed your risk in terms of spread that you're being compensated for. And so we think inherently markets are ignoring this. The following slide really just shows here investment grade credit spreads, and this is the premium that you're receiving on top of risk-free rate, so Government of Canada or US Treasury. That dark blue line is in the United States, currently less than 0.8% you're getting on top of a US Treasury, and in Canada, it's close to 1%. These are inside historical averages. In the US, we're inside by, from 150 all the way to closer to 80 basis points. And in Canada, a historical average of closer to 115 basis points. So relatively expensive, and we have to be very cautious of where we're lending. Even more, looking further into credit is the high yield credit market. So this is below investment grade, is the highest risk in terms of credit. And currently we're sitting at sub 300 basis points. So we're only paid, if we were to participate in a new issue today, only 300 basis points in addition to your risk-free rate. Historically, that average is 530 basis points. And really, as you can see, that line really only crosses through that average, and it doesn't really hover over that average for a long period of time. And for us, we want to be compensated adequately. And today, at these current levels, it is quite expensive, and we don't think that that premium really is paying us to hold on to these bonds.
You've talked about focusing on high quality bonds as investors aren't being paid well to take on risk. But I know your team is known for uncovering unique opportunities. Could you share a few examples of these unique situations and where you're seeing value right now?
Absolutely. So just to start out here, just want to go into a bit of our process first and what's really important for us. Cash flow is paramount when we are looking at lending to a business. We want to make sure that our interest payments are paid on a timely basis. There's obviously a risk that a bond could default, and we do assess that, and we want to make sure that we're getting paid for that type of default risk. What's really important here is when we're lending, especially in these really tight credit environments, is making sure that we're well protected. And so we look through a lot of documentation, trust indenture, credit agreements, and in there's a lot of security and covenants that we're looking through. So things that protect us on downside and make sure that we have good collateral and make sure that issuers can't do things that we don't want them to do. As an example, New York Life Global Funding, we recently did a deal with. It's one of the largest life insurers in the US. It's got a very high quality and well-diversified investment portfolio. And what we like about this is that we rank equally with the insurance policy holders. So we did $350 million of a 7-year bond at a spread of 85 basis points. And we actually think this is quite attractive for a AAA credit. And this is above 85 basis points above the government curve. If you were to compare this though with another issue that was recently done, Volkswagen Credit Canada came to the market with a 5-year issue. It's BBB rated. And this was done at a spread of 100 basis points. And so we think that concession of 15 basis points is really not worth reaching for that extra yield to go into that BBB issue, which would be much more liquid and have a lot more spread widening in a downside event. We rank New York Life as a max loss 1, and we consider this highly liquid in that liquidity portion of our portfolio today. Another example where it's really important to make sure we're going through proper research and what we do is Hertz. On the lower quality spectrum, and typically if you go back to June of 2024 when spreads were, call it 325 basis points, quite expensive for high yield at that time. This is not the type of deal that we would have been looking to do if it was at those market rates. But Hertz needed capital and we worked closely with their team. So we'd watched Hertz for some time and observed them. They needed capital to turn their business around and refresh their fleet of vehicles. So they needed about $1 billion of financing. And we are not going to lend our clients capital out without being compensated for it and protecting it. So what did we do? We negotiated really tight covenants. So cap on secured debt, no cash leakage, so they can't go out and issue dividends or buy back shares. And we did it on 2 different bases. So we always at Canso like to finance a business to get through it, call it weather the storm. And so we did a first lien secured note, which is highly ranked, so it's in line with the revolver and the term loans as well. And this was done on a first lien basis and at an attractive yield of 12 5/8 coupon. If you recall, spreads were about 325 basis points at that time in June 2024. This was done at a spread of over 800 basis points. What we liked about this is the fact that it's well structured and we have a max loss of 1. So remember, that's a maximum loss, or we would have a recovery of 80 to 100% of our capital in a down scenario. We did $750 million of the first lien. Now, we also said if we're going to lend to this company and they have some work to do to fix the business, we want the upside of when they get to the other side here. So we asked them, they did a second lien convertible note, and this was done at an 8% PIK. So this is where they pay in kind instead of in cash. And this issue was quite interesting to see. This is the secured convertible bond. It's a second lien issue that PIKs. And we purchased this to really have upside if the company turns around per the manager's plan. So we bought this, not really expecting that it was going to recover, as you can see in the illustration here. But if you fast forward to the first quarter of this year, where you can see, the price declined and it went down closer to $90, but that was, general spread widening, plus the company had some headwinds there. However, if you look at what happened in April of 2025, Bill Ackman, Pershing Square, they actually came in as an activist shareholder, buying up the common equity, which actually translated into him, you can see here how it reflected on the convertible bond. So what happened here is you saw the price shoot up to close to $160. And when we see liquidity provided in these types of issues, it's important to make sure, if we think it's through the intrinsic value, that we take advantage of these opportunities, especially when there's markets showing a bid for these. So we sold, these are all real trade points where we sold into strength and reduced the position by about 25%. This is just wanted to illustrate for you though, where we will also, we like to buy cheap and take and find good value, but also when things are overpriced, we like to harvest our gains.
Thanks, Faisal. And as we look ahead, how are you thinking about positioning the portfolio? Any final thoughts or insights about what we can be excited about moving forward?
Sure, yeah. So as you can see on the slide here, it really shows our historical allocation to high yield. And this is really the portfolio pivoting in and out of opportunity. So when spreads are tight, like they are today, we have a lower allocation to high yield versus if you go back to during the pandemic or credit crisis, we really wanted to move and take advantage of opportunities, and you would have had a much higher allocation. So today the portfolio is much more conservatively positioned. In terms of our outlook, relative value remains in quality, and you'll see that in the portfolio until we see opportunities. The way the portfolio is positioned today, we've got a healthy yield and for the high quality that we have, with almost 50% in AAA, AA issues. The portfolio has a very high quality, which is all. And when we look at that quality, we think about it not just having high rating, but also extremely liquid issues that we can pivot out of and take advantage of opportunities in the BBB space and below BBB space.
Through our various discussions, it's always engaging to hear how you're able to approach the challenges and opportunities in fixed income markets. I know our clients really appreciate the care and attention that you put into every decision, and it's clear that you're always thinking a few steps ahead. We really appreciate you sharing your wisdom with us today.
Thank you.
The most successful investors aren't the ones who time the market perfectly. They're the ones who prepare, stay disciplined, and stick to a strategy that's built to last. And if you don't feel like you have that kind of clarity right now, or you're not sure your current portfolio fits your goals, let's fix that. If you want to build a portfolio and a retirement plan that keeps you calm and in control, even in the face of volatility, click the link in the description to book a discovery call with me. I'd love to walk through your situation, answer your questions, and help you build a plan that works in real life. Let's take the next step.